we got updated jobs figures, and the jobs report was very good, but both the stock market and the bond market did not react very well. And as a matter of fact, 2025 is not starting off very good. Keeping in mind that every major bear market starts off with a minor pullback, and by no means am I suggesting that we're about to experience a major bear market, but we do need to know what's going on. So let's take a look at the data. So this is the chart taken directly from the Federal Reserve Economic Database, and you can see that the December report shows that 256,000 jobs were added. And you can see the red line. That represents what the consensus expectations were. This report on Friday was quite significantly better than what consensus expectations were. And note that the unemployment rate also went down. So why did the bond market have so much red? Let's take a look at long-term bonds. So the jobs data, that candle that I'm highlighting with that arrow, that is Friday, January 10th, after the jobs data. So the jobs market, very healthy, but the bond market did not like that. Keeping in mind, from this high from September of 2023, these long-term bonds are down 15%. I've talked about this ad nauseum, and this is one of the subjects in my book that I talk about, that bonds we really can't consider bonds to be a safe asset class. And I would argue, and I do so in my book, that you should not be using bonds to manage the risk in your portfolio. Because if we zoom out, this is data going all the way back to 2020. You can see long-term bonds in particular are down, or have been down, almost as much as 50%. Again, this is what we're experiencing here recently. And some might say, well, yeah, don't use long-term bonds. Fine. Here's the aggregate bond ETF AGG. And again, top to bottom, that's about a 20% decline. It's recovered a little bit, but again, if we zero into what's happening lately, this is down about 5% from the September highs. Remember, the AGG ETF has a 30-day SEC yield of about 4.6%. So yeah, you're getting a 4.6% yield, but your purchasing power, you're actually losing 5% since September. Is this really safe? So how did the stock market react? Well, on the screen we have the RSP ETF. This is the equal weight S&P 500, so it's a better measure of the overall health of the United States stock market. And you can see I'm highlighting with that red arrow, that's the action from Friday, January 10th. So why are we seeing an excellent jobs report, but both the stock and the bond markets are not reacting very well? Well, the reality is that the excellent jobs report suggests the Federal Reserve might not be cutting interest rates as many times as people would hope, and the market is reacting to that. Now, the good news, if there is any good news right now, is that the RSP might very well have found support. However, as I record this, it's currently about 8:15. The futures market is down, so today might be another difficult day. With pre-market futures trading down, it will be interesting to see if throughout the day they can recover this support zone, or if we are headed to test the 200-day moving average. Remember that we have to have short-term downtrends in order to have a long-term downtrend develop. Right now, we see short-term downtrends are very, very prevalent. These are the equal weight sector ETFs that comprise the S&P 500, and every single one of them is trading below its 50-day moving average, which is what we would consider the short-term trend. The long-term trend, as marked by the 200-day moving average, you can see how many of them are already below their 200-day moving average. If we look at our proprietary risk gauge, this is our VSI on the far right. This is a monthly candle chart, and this represents the month of January. Remember, our VSI is not predictive in nature. It is just helping us have an unbiased opinion about risk. Remember, there's no such thing as a long-term downtrend that first didn't have a short-term downtrend. And by no means am I suggesting that we are about to experience a long-term downtrend. But remember that the stock market looks into the future. So the jobs market was really good. That doesn't mean that the stock market is entirely healthy and the stock market is going to have a fantastic year, because the jobs market is just one data point. So our conviction is that long-term downtrends first have to experience a short-term downtrend. And right now the stock market is not healthy and we are experiencing short-term downtrends. If you have any questions, let us know.